are live. This is the Chit Chat Stocks podcast. My name is Brett Schiffer, and as always, I'm joined by Ryan Henderson, and we are talking whatever we want because it is the Investing Power Hour, our live stream show that goes out every Thursday. We try to do 10:30, or excuse me, it's 10:30 my time, 12:30 p.m. Eastern time, although sometimes we don't get it exactly there, but you can watch the recordings on the good old YouTube channel or listen in podcast format. Ryan, I didn't come up with a planned. I always come up with a question beforehand, but I forgot to this time. But I guess off the top of my mind, did you see, which I'll talk about later in the show, the clip on CNBC of the guy calling people that don't own Nvidia inherently arrogant?
I did not. No, I apparently missed that.
Well, I'm going to talk about it. I haven't figured out how to share videos using our new software, but I have the quote that we can read out. It's a great clip. It's a short quote, but I think it shows the sentiment around AI stocks at the moment.
Yeah, there's always going to be a stock someone doesn't own. And I think it's concerning when you feel like you have to convince other people to own your stock. That's probably a bad sign. Ideally, I live in a world where I own stocks that don't need to be owned by other people to generate a good return. That's kind of the way I like it. So
yeah, or no one has to own your exact portfolio, right? No one's gonna have the exact same portfolio. But we're gonna get right into it. But I guess as we intro today, Ryan, do you want to talk about our good friends at public.com and only 2 weeks left, or no, 1 week and a half until this new promo they're doing is over?
that is correct. So just one more week. And for all you Chit Chat listeners, public.com is the all-in-one investing platform, but they recently launched options trading. And this is your final reminder that you can get a rebate of 18 cents on every contract traded. All you have to do is lock in your lifetime rebate by activating options by March 31st. It's simple. Create a public account, activate the options, and you're set for life. Then every time you trade options on public, you'll earn 18 cents per contract. Plus, unlike other investing platforms, there are no commissions or per contract fees. So instead of paying big fees to place options trade, you actually get something back. Get your lifetime rebate of 18 cents on every contract traded, but hurry. You only have until March 31st at public.com. This is paid for by Public Investing. You must activate your options by March 31st for revenue share. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. There is some interesting stuff from this week that I want to talk about, and it's not really even this week, but have you kept up with the super microcomputer? I don't want to call it a debacle. Have you seen the ticker trending?
I have, yes.
Have you glanced at the returns?
I have, yeah. I've seen some of our friends on the old FinTwit that have owned it, so congrats to them. I did write, I think, one Motley Fool article on them, so I figured out roughly what they do, although I can't say I'm an expert on that. But yeah, that's all I know.
Okay, well, I'm going to go through kind of the situation here because I can't remember the last time I saw returns like this in a public equity, just a public stock. I don't know if I've ever seen returns this good this fast. So for anyone that doesn't know, super microcomputer, also known as SMCI, that's the ticker, is since the start of 2021, so a little over 3 years, they are a 31 bagger. That means if you put in $10,000 in SMCI, I'm not going to do the mental math here, but you would have 31 times your money in a little over 3 years. Pretty astounding returns. And like I said, I can't think of anyone in recent history who has generated that. Maybe Celsius, but maybe I don't think they did it this quickly. So let's talk about what has happened and why it's happened. It's also kind of become I'm a little hesitant to call it a meme stock because I don't think a lot of the performance is attributable to them being memed or anything like that. But there was at one point sort of not a short squeeze, but I guess people are calling it a gamma squeeze. And I know that's a funny term, but there's actually some merit behind it that caused pressure on the stock. So let's start with the basics. What is SMCI or super microcomputer? Yeah, I'm stealing a quote from their page, but it says, we are a rack scale total IT solutions provider that designs and builds a portfolio of servers, storage systems, switches, software, along with global support services. Basically, companies use them for, I guess, outsourcing server capacity or IT infrastructure. And as companies have been spending a lot of money on AI infrastructure in particular, Supermicro computer, I'm just going to call them Supermicro, has really benefited. So the company, they've been growing over the last decade, I think, as IT spend in general has grown. But from 2019 to 2021, revenue was pretty much flat. It had gone nowhere. It kind of reaccelerated coming out of COVID, but spending really slowed during COVID. So really 2019 to 2021, very little revenue growth. However, with the recent AI spending, I don't know if we're ready to call it a bubble yet. Are we an AI bubble show? Have we determined whether or not that's our terminology for it?
Well, maybe we can table that question for my Nvidia segment, since I guess, well, if every one of our topics each week, or not all of them, I guess, but if a good amount of our topics each week are about AI stocks that we don't actually follow for our portfolio, then maybe there is a bit to this narrative. I'd say one thing, it is unsurprising that a company called Super Microcomputer is the one that gets turned into a narrative stock, because I think some of these, not all of them, Cisco Systems, Intel, I guess people know what those were, but it doesn't really say it in the name. A lot of the times, and it comes back to like the .com bubble, and people would just add .com to everything, or now people are renaming stuff to AI, kind of in your name. Everyone remembers the famous Long Island blockchain debacle, I think. Well, maybe not everyone, but I remember that one because that was peak insanity over the blockchain narrative. This one with the name Super Microcomputer, I think it is unsurprising that this is the one that got turned into the narrative company, even if, as you mentioned here, they have seen some good financial performance.
Yeah, and I'm going to pull up a chart here at some point during this, and I'll do it. I'll maybe take a little break and let you talk while I pull it up. But the demand went through the roof, essentially, is the moral of the story here. And that meant greater revenue for them. I imagine there was even some element of pricing power here as well. And revenue just accelerated at really an unbelievable pace. So they went from flat to moderate growth on the top line to last quarter growing 103%. And that was after the year prior growing 79% on the top line. So just a rapid acceleration over the last 1.5, 2 years. The other part is as demand went through the roof, costs really didn't change that much for them. So while the revenue acceleration was pretty insane, the earnings acceleration was pretty ludicrous. So I'm trying to come up with all these different terms to describe how unbelievable this growth was. But here, I'll give some numbers behind this. In 2021, so for the full year of 2021, Super Microcomputer generated $112 million in earnings. That's the full year 2021. Fast forward to the most recent quarter. They generated $300 million in earnings in this quarter. So they have absolutely seen operating leverage and a major acceleration in earnings, which when you see a huge acceleration in earnings, unsurprisingly, Wall Street kind of pats you on the back for it and they give you the benefit of the doubt. So there's a massive acceleration in earnings, but there's also the expectation side of things. So when revenue kind of flatlined between 2019 and 2021, as you'd expect, investors soured a bit on them because it just kind of seems like another maybe cyclical IT slash, it wasn't AI at the time, semiconductor type business is maybe the term. They thought it was cyclical. It traded at 10 times EBIT despite decent growth over the last decade, traded at 10 times EBIT. Today it trades at 60 times EBIT. So, and you look at that and you're like, oh, 60 times EBIT. Wow, that's pretty ridiculous. But if you think that there's some level of this AI spending that could be sustained or even grow from here, 60 times EBIT isn't too crazy. I mean, if they double again, you're looking at 30 times. If you think earnings will double over the next year, you're paying 30 times forward EBIT. That's not
just a
too
double. Easy.
Well, I mean, the forward earnings right now look obviously very different than the trailing earnings given the recent acceleration. So it's honestly not that crazy. There's a huge discrepancy between the last 12 months and next 12 months. So it's not, given all the multiples that we've seen that get kind of sky high, this one isn't that insane. You really do have to believe that AI spending is going to continue, but it's not this turned into a...
I think it might be a little insane. Like, if you have something that's trading at this number, I think by definition, the analyst expectations are going to be high, but it's not guaranteed that the analysts are going to be right. Like you mentioned, we need this AI spending to continue. And do you know if that's going to continue?
No,
I certainly don't.
No. But I'm saying that if, relatively speaking, to a lot of the other AI stocks that are out there, I don't know if you can hear that, but I've got a siren.
Good old that's the calling card of Seattle, right? Living in a nice Seattle neighborhood. Yeah. It's
26 times next 12-month EBIT. That's the multiple. So if you believe that the EBIT estimates are correct from analysts, then it's still pretty crazy. But the moral of the story here is that there has been major multiple expansion. Elsewhere in this thesis, not really a thesis, but the story, there was a gamma squeeze, I guess. So to add fuel to the fire, SMCI, the stock was absolutely soaring, and then insiders were still buying, which it was near all-time highs, and you're seeing insider buys, and I think that kind of fueled the gamma squeeze. But I'm really not good at talking about a lot of this like volume type stuff. So I found this snippet from a blog called Fabricated Knowledge. It's run by Doug O'Loughlin, I believe is his name, but it's a pretty good description of what happened. So he says, I don't know precisely what kicked it off. Maybe it was the insider purchases near all-time highs, the continued AI hype, or the Russell 2000 overweight problem, but there became a quick and sustained demand for shares, which created a problem for call sellers. Usually it's a relatively orderly process on options expiration day, given that the vast majority of calls and puts expire worthlessly. But when shares go up quickly for calls and the vast majority of calls are in the money, the call sellers usually want to hedge their notional exposure by buying the underlying shares in this case, so they will not be caught without shares on the option expiration day. It checks out, makes sense. There's, when you have a huge rise in the stock price, you're going to have some pressure from call sellers, so it kind of creates even further demand. To summarize, the stock went from basically growing company to no growth, which led to investors souring on the company. And this is kind of like Elf Beauty, right? Where the business was growing for a long time. It kind of had received this standard multiple. Investors sort of believed it deserved to trade at whatever that multiple was. Growth flatlines, multiple compresses. Then you see a huge revenue reacceleration, and you get a whirlwind of factors of earnings soar. So revenue soars, earnings soar even more because you got operating leverage there. The multiple expands, expectations get better. And then there was also, some buying pressure as well. Ultimately, this has led to probably the best stock performance I've ever seen in a 3-year time span. Maybe there was some kind of at the peak of 2020. But if you would have told me that if you just ask me what happened to SMCI before I even looked at it, my first thought is this has turned into a meme stock. A whole bunch of people are buying it. Maybe there's some proof in the numbers, but I would not have thought that it's powered primarily by the fundamental growth. Multiple expansion is a huge part of it, but the fundamental improvement is a larger percentage of the stock growth here.
Yeah, somewhat right, but I'm looking at your numbers: 10x EBIT to 60x EBIT, so 6 times multiple expansion. So
EPS
I mean,
is
I would say it's about half. It's about half and half, right? If it's a 31 bagger, then because you're getting 600% returns on, or no, 500, whatever it is, on a 6x on the multiple, and then probably a similar on the fundamentals.
Yeah, let me pull up some numbers real quick, but talk about this before today, before I kind of went through this story. What did you think of SMCI? Did this surprise you at all?
Well, it's not surprising because it's an AI narrative stock and it's one that's growing revenue really quickly. So you have that combination right now. You're going to get tossed in like the Nvidias of the world. And Nvidia seems to be the magic touch where any executives, especially the founder CEO, if they mention your company, then you're going to go up 10%, and you have that relationship with Nvidia. So it's not surprising, but when I looked at the company and what it does is, buys like the chips from these companies and helps assemble them efficiently and stuff, and work with the data centers as kind of a middleman. I think there's obviously going to be some other stuff in there as well. One thing I thought is that it's low margin, so there's going to be a lot of operating leverage here as they scale, which can be a good or a bad thing. And then second, I'm not sure exactly where you build a competitive edge as a middleman assembling these data centers, where there's any unique insight, where I kind of think you have the scale if you are, Amazon, Microsoft, Google Cloud, whoever building the data centers, and then you have whatever edge Nvidia, AMD, Intel have in building the chips. I don't know, brand value, performance power, the R&D advantage. But with these companies, I'm not sure why I would bet on them having a sustaining edge if you're kind of just assembling the data centers. I feel like you're in a weak position, but I'm no expert on the industry, so I could totally be wrong. But first read would be that middleman position would be a tough one to be in.
Yeah, I'm going to share my screen here. I know podcast listeners, you can't hear this or you can't see this if you're just listening to the audio, but I'll describe what I'm seeing. Pull up my full screen here. We do this on YouTube live on Thursdays, by the way, if you're interested in ever watching it live. If not, here's what I'm seeing. Since fourth quarter of 2018 to the fourth quarter of 2023, so I guess that's 5 years. Is that 6 years? It doesn't matter. The earnings per share has grown at a 71% CAGR, albeit off a slightly low base. But it's been a 1,400% growth in earnings per share. And that compares to basically 4x in revenue. I'm looking at the quarterly revenue here. So a lot of it has been driven. I mean, obviously, expanding your multiple by 6 times certainly helps, but this is the blueprint for a multi-bagger, right? You're generating, you are starting at a low valuation, which gives you plenty of upside. And we can say, oh, the valuation's ludicrous today. It's insane. But I mean, you could also look back and say 10 times EBIT for something that could have turned into a huge growth business is ludicrous to the low side. So I think this is kind of the standard multi-bagger, right? You're getting both multiple expansion and huge revenue and earnings acceleration. So pretty impressive for anyone who's owned shares. I don't know if you could have foreseen the AI hype cycle coming, but if you did, and that was a part of your thesis, I've got to say kudos, because this is the best stock performance in a short period that I have personally ever seen.
Yeah, it's definitely high risk, high reward. So the outcome being large reward, I think it comes with the fact that it was high risk, right? And I don't think it's surprising to see such strong returns. Yeah, incredible returns, but I think we have a good comment here from Tyler saying the $1 million question is whether current earnings are sustainable. Anyone who has invested in cyclicals, mining, oil, others would be familiar with this analysis challenge. This should apply to both Nvidia and SMCI. Probably right. And I think the difficulty for me looking at these sort of companies is that you almost get forced to make a sell decision, which is tough. I'd rather be in a stock that doesn't really get into that zone and have that risk of the cyclical. Because if we, you could see if the AI spending goes down, this thing is in trouble. And you would not be surprised to see a 90% drawdown. Now, if you bought at the absolute low, okay, you're still fine. But I mean, that just does not seem like a fun ride. It seems highly stressful. And like, okay, it's amazing if you had the returns to here, right? And kudos to you. But one thing, like you mentioned, could you have predicted that? No. When would I have sold on this run up? I think a lot earlier than this, given the cyclical risks that I just mentioned. And I just don't know if it's one. It's almost like someone, I don't want to call it roulette. That's probably misleading because some people, I'm guessing, had good fundamental theses here, but I don't know if it's a replicable process to, to, to find these. It's not something you can take home to.
Yeah, especially
It's
when
got to be a little bit luck.
Yeah, I mean, especially considering what's happened with AI spending, it would have just been really hard to predict. However, there are probably people who had a good thesis intact that didn't have the AI spending, and it was just cherries on top. And you probably would have made decent money buying at 10 times EBIT, sort of a trough multiple in 2020 time
Definitely.
period. And just to be clear, yeah, I would not buy shares today. I do think the AI spending has a chance to revert, and some of their customers might pull back or contract their spending. So it seems, yeah, highly speculative. But I did like to see that it wasn't just some like pump and dump where
Right.
management
Kind of
got
the
out.
AI. Yeah.
Yeah. Like management insiders were buying probably prior to the huge gamma squeeze, and that's probably when I would have got out, is when I started hearing rumblings of a gamma squeeze. I think that would have been like,
Yeah,
okay, time
usually a
for me to
good time
go.
to trim. Yeah, at least trim when you hear anything about your stock being a gamma squeeze or people's thesis being that it's the highest weight in the Russell 2000. It's probably a good idea to at least trim. But
Yeah.
yeah.
I mean, it's fascinating. It seems like at first, whenever I see something that goes up like 30x, especially now, given what's happened with like the GameStop and all that stuff, I just think like I get a little bit of Schadenfreude. I'm like, well, that's not sustainable. Everyone's going to lose money. But when I looked at SMCI, I was kind of like, oh, you know what? Good for management. They've been running this business fairly, it seems like, for more than a decade. So good for them.
Yeah, at least there's a fundamental story here where if you look at all the crypto nonsense, you look at something like C3 AI that just had the ticker AI and then said they were some sort of AI company. Although when you actually look at what they do, you're like, what are you doing? You're not even growing, blah, blah, blah. That's a whole another case. And then, something like that was just soaring. It's a way different story here because it seems like SMCI actually provided value. And maybe if, like you mentioned, there's kind of the bloggers and the analysts that cover specifically the semiconductor sector, maybe you could have seen SMCI as a good risk reward back when you mentioned at 10 times earnings if you followed the sector closely. But I think as a generalist, it would have been a tough one. Is there anything to learn here, or is it just another one, as you mentioned with Elf Beauty? The combination of revenue acceleration with a decent starting multiple is just a great recipe for rapid stock appreciation.
Yeah, I don't think I could have predicted either of these. Obviously, I didn't predict either of these. And when you see flatlining revenue, it's really hard to think, unless you follow it really, really closely, you probably have to own shares to follow it this closely. It's hard to imagine that revenue is going to quadruple in 2 years. I mean, it's just
Right.
like, how do you predict that? So I don't think I would have got ELF. I don't think I would have got SMCI, even if I was looking at them on a regular basis. So I don't know if there's any real takeaways, except for the fact that if you really want a multi-bagger, if you really want returns like this, paying a starting multiple that's pretty steep, you're not going to get this level of returns. You can still do well, especially if the fundamental performance looks like what SMCI has had, but you're not going to get those potentially 100 baggers in short order style investments.
Yep. And I think it comes back to this gets tossed around all the time, is I think the stat is, and again, I'm remembering this, I haven't read the data in a while, but I believe most of the 100 baggers start out in the 10 to 15 times earnings range. So I think that's a good kind of bogey to go after. Let's
Yeah, and
talk
it's
about one
I
more.
was
You have
just
one more thing before we move on.
I was just looking at like the best performing stocks over the last 5 years, and a lot of them are like that, where it's 10 to 15 times earnings on like trough earnings,
Right.
where, or maybe not trough because they're not all cyclicals, but where there's been a deceleration and people are just
Yeah. A
telegraphing.
slowdown, downturn
Yeah,
kind of deal. Yeah.
but
Okay. Well,
so hard to predict.
yeah. I totally agree with that. All right. I'm going to talk about my psychological short book performing absolutely phenomenally. What I mean by that is stuff we talk about being bearish on, but we actually never make money on it. But first, Ryan, you had a great chart that you pulled up right away with SMCI to kind of show what was fundamental performance, what was multiple expansion. Where can investors and listeners obtain these charts?
Yeah, I should say a lot of people seem to be taking these words of encouragement to sign up for FinChat seriously, because a lot of people have already done it. This FinChat.io, it's my personal research terminal. It's Brett's research terminal. It's where I keep my dashboard and track all my stocks, and then where I do a lot of my research. And I used to think, I'll just build my own charts myself, because I thought I enjoyed doing it. This has saved me so much time, honestly. They have basically every financial measure you could look for, and they've got the segments and KPIs that you're probably tracking anyways. So it's been a huge time saver. And with our code, you do get 25% off any paid plans. It helps us, helps you guys, I think, especially if you're doing this on a regular basis. If you manage your portfolio pretty actively, I think it's worth tracking them with an actual research terminal that you pay for. So it's finchat.io/chitchat. That's finchat.io/chitchat. You get 25% off any paid plans. They've got the Plus and the Pro. I don't have the prices with the discount included, so I'm not going to say them. But yeah, you're getting 25% off. At least check it out. finchat.io/chitchat.
All right, beautiful. And yes, thank you for anyone that has used our link. Ryan mentioned the code. There is no code, but the link is in the show notes. And if you can't figure that out, DM us, email us. We'll help you out. Okay, next topic. And I'm glad this came out because it came out right before we started recording. Apple is officially getting sued by the Department of Justice in the United States. Let's give some context to what they're trying to do here, and then we can talk about our takes and any investing implications. So, quote, the Justice Department sued Apple on Thursday, alleging the tech giant blocks software developers and mobile gaming companies from offering better options on the iPhone, resulting in higher prices for consumers. One thing I thought was funny was that the DOJ says Apple succeeded with the iPod because they did an antitrust suit against Microsoft. I would call that a little bit of a stretch, although I guess I wasn't following the markets at the time. But besides that, people were kind of making fun of that part of the case. But there was a lot of other things that have been talked about for years now. One, they mentioned inhibiting growth of cloud gaming, which is interesting as this is sort of a nascent category that has a very uncertain future. But they're saying that Apple kind of holds the keys to the kingdom here, and they're going to basically, if the tech starts getting popular, it's going to be very difficult for anyone except Apple to come up with any sort of service here, which really reduces competition. They talk about inhibiting the growth of other applications, plus the classic 30% take rate on payments that we've all heard of, from time to time. That is a huge cash cow for Apple. They talk about iMessage degradation. We actually have a full quote here. For listeners, I guess, that are unaware about it, and if you're younger, you might be aware of it in the United States, but if you're international and you have WhatsApp as the primary message service, you might not understand this, but in the United States, it's very important. I think I'll read maybe part of this full quote here. For example, excuse me. In addition to degrading the quality of third-party messaging apps, Apple affirmatively undermines the quality of rival smartphones. For example, if an iPhone user messages a non-iPhone user in Apple Messages, the default messaging app on an iPhone, then the text appears as a green bubble and incorporates limited functionality. The conversation is not encrypted, videos are pixelated and grainy, and users cannot edit messages or see typing indicators. This signals to users that rival smartphones are lower quality because the experience of messaging friends and family who do not own iPhones is worse, even though Apple, not the rival smartphone, is the cause of that degraded user experience. And then they go on to talk about how the effect is way more powerful for younger demographics. I could have said it better.
They got your
myself.
back.
That they are. I literally could have wrote this. I read this and I was like, wow, this is me. And I think a lot of other people,
some
too,
Android user, some disgruntled Android user in the Department of Justice. It's like, I'm finally stepping up.
What do you? Yeah, maybe we can talk about this one first, because it's interesting to see this finally becoming an actual legal battle. What do you think? Do they have? I know we're not legal experts, but from maybe a common sense perspective, do they have a case here?
I don't know, because it's like, is it on the one hand, is it just like a competitive tactic to win? Is that like technically illegal? I don't know. Are they purposely? It sounds like, as part of the, I guess, do you call this an accusation? The accusation is that they are purposely making it like lower quality for everyone that doesn't
Making
own
the
the phone,
experience worse for
as
the
opposed to
customer.
just making their experience better. They are intentionally making the other experience worse. I think you at least have a moral obligation or like an ethical obligation to not do that, if that's the case.
To treat your customers well. Yeah. Which I don't know if
Yeah,
there's
and
a
just
legal argument there, but
yeah, that's the thing, is that a lot of this stuff feels like kind of blurred lines, where it's like, is it them making the experience on the iPhone for iPhone users so good that people are frustrated not having one, or is it them having an ethical obligation to treat everyone the same? Which I don't know if they do. I don't know if are they legally obliged to make every single Android, iPhone, smartphone user have the same experience? My gut kind of says no, they're not.
Yeah. And yeah, on the one hand, you're right. On the other hand, I have a soft spot for, say, a young family that has a couple of kids, and the kids are telling them they can't make friends unless they have an iPhone. And you're like, look, this is going to stretch our budget a lot. And, something like that, where if you might be, you don't have you're not a high earner or anything like that. And you're like, look, I could buy these cheaper Androids, but I got to buy an iPhone, or else, Susie says she's not going to have any friends. Like, part of me thinks that that's what, I mean, I'm not in these households, but I have a high confidence that that's what's going on. I mean, you can think about how kids act if the younger people are saying that you have to have these messaging services to basically be a part of these friend groups. It seems to me like there's a lot of power here that should probably be regulated. I don't know how much it's going to impact Apple financially, though. Stock's down about 3.5% today. I think more importantly is the App Store and the Google payment, because those are actual profit, like huge profit drivers for the company.
Yeah, you want to talk about the proposed deal that they have with Google?
Yeah, maybe. I don't know if I have the details on that, but it was basically putting Google Gemini type stuff within the iPhones. I think the only takeaway I had, and I'm probably an idiot on AI, but I think it shows that Apple is behind the eight ball here, specifically with AI. What do you think?
Yeah. Or they think Gemini is good enough that it should be a part of the, or they think it's just so superior on the AI
Right.
front, or they don't trust Sam Altman.
Yeah, that's another point. It probably shows people are a little skittish around AI, or excuse me, open AI. Yeah. What did you think about this lawsuit? Did you read any of it? I know it came out about an hour before we started recording.
No, to be honest, it feels like they have so many ongoing lawsuits, it's hard to track.
Yeah.
But I guess this one might be more significant than the others.
Well, yeah, this one, it's its home market, biggest market. I think. Okay, here's the question. Does it have an impact financially on the company 5 to 10 years from now?
Yes, would be my gut reaction.
I think
I
I would
think
agree. Okay, you go
it
first.
just feels like the walls are closing in from all directions. I don't know if the DOJ case specifically is the one that hurts them, but it feels like they have so much backlash, both from the development community, from other big tech companies, rivals, and in this case, the government as well. So, yeah, it seems like the walls are closing in, and I imagine this eats away a bit at the margins of their services side of things.
Yeah, and I also saw today that a consortium, I guess just a fancy way of saying group, of both Microsoft, Meta, X, which is Twitter, Spotify, and Match Group are joining Epic Games in a new um, lawsuit to sue the company to open up the App Store. So that's just another one that adds on here. I think I would lean yes as well. Not necessarily because of the customer tie-in, because I think if you eliminated this iMessage advantage, you eliminate some of the lock-in across the Apple Watch, the AirPods, whatever. I think people still would go to Apple products, but I would be very concerned about the services profits.
Yeah, I agree. I mean, 30% take, if that comes down, that's probably a decent chunk of it, especially if they reduce their payments to Google.
Yeah. And what's interesting here is that the last part I thought was that they didn't mention, like, and maybe it's because they're doing this in Europe, but they didn't mention Apple competing directly with companies such as Spotify with their own service, even though they are essentially, you know, you have to go on their rail track, their railroad, and yet they're competing with you on what, service people should buy. And I'm not necessarily saying that a company can't do that and vertically integrate, but the fact that they can do so with minimal regulations and the proven stuff where the European Union just fined them $2 billion around this of um, basically making it much more difficult for these direct competitors to operate, to put promotions within the app, to get updates to the App Store. Spotify routinely says that they have the same, basically the same application across Android and Apple, except that it takes them much, much longer to get approved for updates going on the App Store. So you see that, and yeah, it doesn't prove malintent, but when you have these pieces of evidence, and you have Apple Music competing with Spotify, and you have this true with Apple TV Plus, blah blah blah, some other stuff. That one makes a lot of sense to me. I'm not sure why it's not the focus here of the DOJ case, because they spent part of the the letter here just bragging that they tried to, you know, stop Microsoft from being an all-powerful entity, and they think for some reason that's why the iPod was successful. I would say the iPod was successful because it was a great product. Had nothing to do with Microsoft, but yeah, I think that's my take. I'm not surprised to see the stock down. It's been underperforming probably because of these sort of things coming down the line. And as you mentioned, there are so many lawsuits right now coming against this company that I, maybe one of them sticks and it hurts them here. But again, I think I've already said it twice. The key is the super high margin services revenue from the App Store and the distribution payment from Google.
Yeah, I think we've kind of talked about it enough. It feels to me like the walls are caving in. There's not much Apple can potentially do here, except be more open to the rest of the non-iPhone user community. So we'll see what happens. Do you want to talk about this Nvidia God trade event?
Yeah. Okay, yeah, we got some comments here. Let me see if I make sure. Is the AI software going to have too much competition where only a select few win, as well as the picks and shovels companies, semi stocks? I'd say that's a $1 trillion question right there. Fake alias, I'm not sure. And you probably should ask a different podcast. Let's see. It sure looks like, according to Tyler here, that the value of LLMs will accrue to infrastructure, AWS, Azure, GCP, data owners, big tech, and consumers. I think I'd lean to that first part. I'd have a high confidence in, where you have a lot of value going to the internet infrastructure companies. Now, which ones? I'd say probably the cloud providers, but TBD on others. Let's see. Anything else? Yeah, let's hit this Nvidia one. So I guess it's an AI themed show. Maybe this is a signal at the top, but I thought this was absolutely hilarious. And there were more bubble vibes, I would say, on CNBC. I mean, when the CEO of Nvidia is doing a keynote speech and it's indistinguishable from a rock concert, I think maybe that's a sign that there is very, very high sentiment here. But this was a clip on CNBC. If you want the full video, I think you can probably find it because it went slightly viral on the good old FinTwit. But if you can't find it, DM us on Twitter. We'll share it with you. It's less than 30 seconds. I only have a good clip here. And they're talking about owning Nvidia versus not owning Nvidia. And here's what the quote is. I wrote this a few weeks ago and called it the Nvidia God trade. If you don't own it, what you are saying is you are God. An inherent arrogance to say I don't own it based on current valuation. Now my question for you, Ryan, is are you God? Because you don't own Nvidia.
Couldn't you flip this? Couldn't you just say that if you own it, you're God?
That's exactly what I was thinking. It's like this is price driving. People talk about price driving narrative. I think this one is price driving arrogance.
Yeah, I mean, there's two sides. Every valuation discussion has people on both sides. That's why the valuation is where it is. So you could easily flip this and say that if you own Nvidia today, you have a clear understanding of what the results are going to look like in the future, so you know the valuation is lower. I mean, this is just yes, arrogance is maybe the way to describe it. He said this on CNBC.
Yes, and I don't think the tone I was giving there is doing it justice. The guy, slick back hair, very nice suit. He's doing kind of, I don't want to do it that angle, but he's doing like kind of like an up and to the right thing where he's saying, if you saying you're not going to get along for this ride, like you're just saying you're going to underperform, man. And he's kind of, I think it shows the mindset of a lot of investors is that they have this thing where they believe you can't underperform ever. And it's like, okay, if you don't own Nvidia, you're going to underperform over the next 3 months. So you have to own this thing. And it's like, I don't care who owns Nvidia. I don't care if I underperform. I want to own stuff I'm comfortable with, stuff that I believe, are quality businesses that I'm buying at a reasonable price. And if they're flat for 6 months, that's fine with me.
Yeah, this is a pretty outlandish quote. I think CNBC knows this clickbait works, and it worked for us. So
yeah,
we've
we're
tuned
talking
in.
about it. Yeah.
Okay. Question for you.
Here's okay. Is it related to AI or
No, not at all.
Okay, well, we have one good comment here. Then we can go to the next topic. Once all the big tech companies have all the AI chips they need, what happens if R&D is not ahead enough to warrant these companies upgrading to new AI chips? Thank you for that comment there, fake alias. I think I would even broaden that out as, look, there's so much spending here that there's just an absurd amount of quote unquote invested capital, right? Whether you're calling it or not. The returns on that there has to be such a good return here to warrant all this investment. And I'm just nervous that we're not seeing that.
I think the idea here is that the need for the question says, what happens when they have all the chips, AI chips they need? I think the idea is that need keeps expanding and that there's enough use out of whatever these AI models, and they're generating enough return on their AI spending that it can continue to grow. I would probably take the other side of that as well, because I know you were about to say that, Brett.
Yeah.
But
ad targeting better get quite good, or else this, you know what I mean? Right? How much better is advertising targeting going to be? All right. There's only so much money people have in their pockets, but we can't talk about AI the whole show. Don't want to be an AI focused podcast. What was your question, Ryan?
I was looking at some, basically trying to find like some serial acquirers that have done well. And there was a number of companies from Sweden. So it got me to thinking, if you could only invest in one other market and you weren't allowed to invest in the US, what market would you choose?
Now, if I could do all of the Nordics, I'd maybe say that, but Sweden's up there. Got a comment here that says India. I think it's a good choice. I believe I saw that their market is super expensive right now from an earnings multiple, but I mean, it doesn't mean there's a lot of opportunities there, and their GDP is growing extremely quickly. I think Sweden's a good choice. Some people like,
I think Japan is up there for me.
yeah, some people like Australia because it's cheap and there's a lot of publicly traded stocks, but I think the quality is low. Britain, yeah, I don't ever really see that many exciting companies coming out of Britain. Japan's a good one. I mean, that's a large market. What about
there are
Mexico?
some there are
What
some
about
good
Mexico?
businesses in Britain. I think maybe we just don't spend that much time looking there.
Okay, there obviously has to be at least some, but I'm saying generally I don't get too excited.
Canada's not a bad shout. That's kind of cheating, but
a little Australia, like though, a lot of energy, a lot of mining, a lot of banks. Then Shopify and Constellation Software.
Yeah,
that
if you look at if you just look up the biggest software companies in Canada, it's like Shopify, Constellation, huge gap, everyone else.
Yeah, it is. That is interesting. I don't know if I'd say Sweden, but it'd be up there. I think if I'm going to go my top 5, I would go, and this is outside the US, if this is a clip, Sweden, Mexico, Japan. I think, I don't know if there's any others that excite me that much.
Yeah, I mean, there's a couple things I would want, right? You'd want some diversification in terms of where the number of companies in each industry. You wouldn't want it to be super energy heavy and like no software companies, or vice versa. I'd want some sensible fiscal policy and
rule of law.
Yeah, and rule of law. So some stability. you'd want probably a culture of rewarding shareholders, which I think is a bit where Japan lacks. So I think Japan checks a lot of these boxes, but they lack in that department where they're just maybe too conservative. That might change in the next 10 years, who knows? But it's at least been that way for the last decade. And then probably some good demographic tailwinds. I don't think you want a country where they're constantly losing, that they're a net, what is it, emigrator? Where
a huge
yeah.
demographic loser, which would be countries like Germany, Italy. I can't name them all off the top of my head. China, of course, South Korea, Japan's in there too. So I think
You
Japan has
probably
some good
want,
quality.
yeah, political stability is probably a big thing here too. So I don't know.
Yeah.
I think a lot of South American companies, I don't know if they'd be my first choice.
Yeah, we have some people here saying Brazil. One, like they're a part of BRICS, so clearly they don't have the tightest relationship with the U.S. and their allies. I would much rather have someone like Mexico. I think that whether you have, I mean, they're not best friends, the U.S. and Mexico, but they have a very tight relationship. You know, and the cultures are much closer. So I think we've talked through this. I kind of didn't have any prep here. I think Sweden and Mexico would be my top choices, and maybe Canada, honestly. Except I just don't like the composition of the companies there because a lot of the
Energy heavy.
Canadian influence, like you have Costco's there. You have a lot of U.S. companies that I wouldn't technically be able to invest in, but are contributing to the Canadian economy.
Yeah. South Korea, maybe. Although it's pretty tech heavy, I think.
South Korea and Japan feel similar to me. You have these conglomerates, just some maybe some undervalued stocks. You have the demographic worries, and then they're both as positives. Tight relationship with the United States for that.
Yeah, I think you're probably right. If I could take the Nordics as a whole, that'd probably be the easiest. They seem to have they're very shareholder friendly. Lots of publicly listed companies over there. Lots of diversification in terms of industry, and they're generally stable countries. So I think I'd like that.
Yeah, I think there's just a good track record too, a great historical track record in Sweden of generating shareholder value, building these durable businesses that have done well over decades. And I think whatever the culture is over there, maybe they have a patient mindset, maybe they have a long-term mindset. Maybe they're more frugal. They're not about, spending on corporate jets like CEOs in the United States might be. But and I just read the GE book, so I was, finally read that anecdote about the CEO with the double jets, the backup jet going around there that cost $250,000 per each trip. Did you know that? Each one.
Well, it's important.
Well, it's important that yeah, that's worth it apparently. But yeah, I think they might have shareholder friendly values, even though I think from the outside you look at them and they have that democratic socialist narrative. When you look at the on the ground, well, some of the stock performance of these conglomerates and just operating businesses have been quite good. I mean, even recently, you have Spotify has been large. Obviously, it kind of came public at a tough valuation for its stock performance, but then you have Evolution Gaming. You have the older companies. There's some of those industrial conglomerates that have done really well. And I'm sure, I don't know, were there any other ones that came to mind for you?
No, there's just a lot of conglomerates that, like a lot of serial acquirers that I had no idea about that have done a really good job.
Oh, Swedish Match.
A couple roll-ups, like some are diversified holding companies, but a lot of them are kind of roll-ups within their industry. And maybe we should add a segment to this called Hidden Gem Watch. There are a couple that I have found that I kind of like. There's Vitech Software Group. Not a recommendation. Check it out. pretty impressive performance, compounded annual returns of 42% over the last decade. So they were pretty small to begin with, but they've done a really good job just
Is that
eating up
the
software businesses, it looks like.
little bit of Constellation software style?
Yeah, seems like it. There's another one, I believe it's called like Lifeco, LIFCO, and they've been just like eating up or rolling up dental equipment businesses, and they've been doing a really good job also. So there's a couple in there. I just looked up like best serial acquirers out there, and there were a ton of Swedish companies that had generated pretty impressive returns.
Interesting. And maybe part of the attractiveness of the Nordics is that you don't have, unlike in the United States, there's not the private equity influence where private equity in the United States might eat up a lot of these businesses and keep some high quality ones away from the public markets, which is tougher for individual investors such as ourselves. But if you go to a different country, maybe there's more of them left.
Yeah, a bit speculative, but I wonder how much private equity is going for companies abroad as well.
That's true. Yeah, I have no clue.
I just hate the private equity. No, I don't. I don't love the idea of just a whole bunch of small family businesses being turned into private equity shops.
Yeah. I also don't like the ones when they have the stories about the healthcare businesses that just get whatever they are, senior living facilities, hospitals, what you name it, just getting bought up by private equity. And I'm sure some of them treat them well, but there's a lot of horror stories about the quality of the service going down. Yeah. I mean, yeah. Okay. Had a comment here. I don't know if you have anything special on this, but Tyler says, if you guys run out of topics, do you think Tinder reaccelerates growth in users, payers, ARPU, etc.? Do you think Match is going to keep growing or taper off? I think I'll go first here. I saw someone throw out a tweet that I thought was interesting, and they said, if Match Group and Bumble have turned into the same kind of operating duopoly, give or take, as Uber and Lyft, why are the stocks basically in the dumps while Uber and Lyft have started to do well? And I'm interested in what you think of that analogy and the narrative on Uber and Lyft for a long, long time, and maybe still Lyft, were that they couldn't make any money. But if you and I was a part of that for a while, but then I've changed my tune. But if you looked at the underlying unit economics, it was actually quite strong and there was minimal competition. And I think there were some bear arguments about the total addressable market for Uber and Lyft going down, not being that large, stuff like that. Do you think that comparison makes sense? And full disclosure for the listeners, we are a little bit biased to the dating app stocks as of this recording. We both own shares in Match Group.
I don't know if I love that comparison. My concern is really more so with Match Group and even Bumble that they're maybe closer to saturation than everyone believes. Whereas I didn't really think that for Uber and Lyft. They kind of carved out. I would say they're even still further away from saturation, Uber and Lyft are, than Match Group potentially. And maybe that's just the current numbers talking, but do I think Tinder reaccelerates? Maybe on the top line, but I don't know if I would expect Tinder to really grow its user base that much more unless they have a lot of success in markets that they're not already in. But as far as I remember, they're in pretty much all the big international markets already.
Yeah, I think I agree with you in the developed markets where everyone has access to the internet already. And these are going to be lower value markets from an ARPU perspective. There are still a lot of countries out there that are adding internet users every year. And I think what Westerners, or also, I guess it's not just Westerners, it's places with very strong internet speeds underestimate, is that when someone just first gets the internet, your speeds are so slow that a lot of this stuff is unusable. You're not going to be able to stream music, video, I think stuff like dating apps are going to be very, very hard for you to use until the internet speed. You don't just get your first access to the internet, but you get much, much stronger speeds on your mobile device. I think there's still some tailwind there. For example, like 100 million people are adding, internet usage in India and surrounding countries every year. But I agree with you that I think the users, I don't know. I'm not sure. It's not going to be like YouTube where everyone in the world has an account.
Yeah, that's accurate.
But
I mean, not even all the single people will have an account.
Exactly. And I think the thesis, if you own Match or Bumble, is that the pricing power on these things is consistent with good unit economics. Like, you're going to be able to grow prices ahead of inflation with very, very good margins. Yeah, that's really it. And then increasing the percent of people that pay over time.
Yeah, there's a comment here from Tyler that says it's not similar network effects. So he says you can't have a rideshare app without users in many cities, but you can build a dating app for a small subsector. So Uber and Lyft have no competitors, but Match has to constantly compete with potential new small competitors. I don't agree on this. I think you really do, especially now, need scale beyond. Like, I've never seen a dating app that excels in one city.
Right.
And that's it. Like,
because people move, travel, going to university.
It's really, really hard to start a new one and succeed. And it's pretty surprising that Hinge was able to do it. John Gallagher says, "Hey, gents, I don't seem to get notifications that your show is starting. We got to start. We got to find a way to fix that somehow."
Yeah, to be honest, the stuff is the recording software and YouTube itself. YouTube is in a fortunate spot that everyone's forced to use it because stuff's hard to work. But I'll make a note to try to figure that out to get a notification. I try to tweet it out sometimes, but I guess I didn't today. But maybe there's a setting we can change. But sorry, what's his question?
He says, "Are you making the pilgrimage to Omaha in May?" I don't think we are.
Don't think so. Sorry about that. I would go if it was cheaper. I guess it's sorry, JV Diamond raises the price on some stuff.
Yeah, I do want to go. I really want to go, especially this year, just given with Charlie passing. It seems like it'd be fun. I imagine a lot of people will go out this year.
Yeah. If we didn't go 2 years ago, I would definitely go. But we made the pilgrimage once.
I don't know if I'll be, even as I have more spending power over the years, I don't know if I'll be a regular like every year, but I could see myself going like once every 3 years kind of thing.
Yeah. Yeah, I could. Yeah. I'm definitely not going to be a regular. I will say, though, our university is playing a NCAA tournament game in Omaha in that same arena in approximately 12 hours. No, 9 hours.
Yeah.
So there we go. They got some good value investing juju, right? from the old Buffett master. Okay, well, we went a little bit over, but appreciate those nice questions from the listeners. Again, yeah, we may want to figure out those notification things, but I just say if you subscribe to the YouTube channel, it should show up. I try to tweet it out on the Chit Chat Stocks Twitter, but either way, we try to go 12:30 p.m. Eastern time for the live show. If you care about that, you can add in your questions, which we usually try to answer because we don't get too many comments, so we'll probably answer yours. But if you don't listen to the live stream, you can watch the replays on YouTube, and then you can get the same podcast in audio format in your podcast player of choice, whether it's Spotify, Apple Podcasts, Overcast, you name it. Make sure to follow us on YouTube, Spotify, or Apple Podcast. If you enjoy the show, the best way to support is to give a quick 5-star review on Apple Podcasts or Spotify. If you want to keep up with the show, you can do so on Twitter or Substack. Just search Chit Chat Stocks. You'll get them there. Let's get the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, in the comments for tuning in. Thank you to all the listeners, and we'll see you next week.